Hi, thanks for tuning in. My name is David and you're watching Critical Trading. The equity curves visible on my screen belong to my automated stock trading system portfolio that I trade in the US equity markets. There's only one difference between these two curves, and no, it's not the trading strategies. The strategies that make up this portfolio are identical. The only difference between these two equity curves is how the trading capital is managed on a portfolio level. As you can see, the difference is quite significant, and I will walk you through what it is and how you can replicate it in your own trading in today's video. You see, the problem is that most people focus on trading a single trading system, which is okay, but it means that they will never get their hands on some of the great benefits that portfolio of trading system comes with and has to offer. When put together right, one can decrease the risk and increase the return potential at the same time, which is very, very difficult to achieve on an individual strategies basis. I made several videos on this topic before, and I strongly believe that running multiple trading strategies in a portfolio is one of the very few avenues that offers decent odds of success in trading. Let me walk you through my own portfolio and one particular technique that I've recently implemented myself to increase its performance significantly without trying to over-optimize individual trading strategies. Let's start with a single system. It trades all stocks in the S&P 500 on weekly time frame. Before I go over some of its trading rules, let's just have a quick look at its equity curve, as it holds a key to what I'm about to show you in today's video. We can see that following a new equity high here at the end of 2021, this system got into a drawdown and subsequently stopped trading. This is because the equity curve goes flat here, and that means that this system was not taking any new trades due to unfavorable market context. To be more specific, this system only enters into new positions when the S&P 500 index shows strong momentum. In 2022, when the market plummeted, the momentum was lost, and so no new positions were entered into by this system. Now, that logically means that whatever the capital this system works with, it will be sitting unused in my trading account, wouldn't it? If I only traded this system on its own, I have no option but to sit still and wait. However, since I'm trading this system as a part of portfolio of multiple systems, I have some options as to how to use this capital, perhaps by lending it to other systems. You may see where I'm going with this already. Let's go over this system's trading rules. It uses weekly time frame to generate buy and sell signals. It looks for oversold stocks with RSI indicator readings below 20. RSI uses period number 2, and a corresponding sell signal is when the RSI crosses above 80. Once again, this is a weekly time frame, and this is an actual trade that this system made with an entry here at the beginning of this week and a corresponding exit here at the beginning of the following week. What's important to take away from here is that because this system works with weekly time frames, it generates buy and sell signals once a week only. This means that once weekly entries have been made, I know for a fact that whatever residual capital is left, it will be idle until next week. This system allocates its capital among a maximum of 10 trading signals, but what may happen occasionally is that it's not fully utilized, perhaps because it only got 5 signals in a week. So what if I take whatever idle capital is left after entries have been made and temporarily lend this capital to other strategies? Well, let's have a look. For comparison purposes, let's start with this system's performance on its own. 13 years of history, realistic backtest assumptions as always, including trading costs and historical index constituents. If you don't know what the latter means, then I highly recommend you read into that, as it's extremely important when researching trading systems in stocks. We've got 17% average annual return and a drawdown of 38%. These figures are inclusive of 50% margin you get from your broker. Now, let's include other systems as well. I've included 3 more trading systems that are part of this portfolio. All 3 systems are of a very different nature to the first system. They all trade with much higher frequency as they trade on daily timeframes, and they are based on a much wider universe of stocks. And 2 of them are actually kind of a hybrid in between swing and intraday trading systems, as they only hold their positions during a single day only. Overall, their capital turnover is therefore much more rapid, much higher than the first system. Starting from 2022, we can see that while the first system is done very poorly, other 3 systems manage to hedge it slightly. Performance of this 4-system portfolio is as follows: 48% average annual return, while the drawdown is now at 13% as opposed to the original 38% of a single system. Now, before I get any further, it's worth pointing out that one of these systems short sells stocks. In reality, not all stocks are available to be shorted at any given time, and so the performance in the real world would be worse, or everything else being equal. I'm not able to factor this into my historical backtests. Now, even after I account for that, the main metrics improved significantly when trading portfolio as opposed to trading a single strategy. There's no doubt about that. However, we can still do better. Let me show you how. This chart shows the capital usage of the first system I started this video with. The vertical axis ranges from 0 to 1, as in 0% to 100% capital usage. We can see that within this time period, the system started with 30% usage, meaning that it had invested into 3 different stock positions out of a maximum of 10. Then it closed the existing positions, but did not open new ones, which resulted in its capital exposure dropping to 0%. This is because, like I said right at the start, it employs a market momentum filter, which in this case prevented this system from entering any new positions, resulting in its allocated capital to be idle throughout this roughly 6-month period. So how do we use this to our benefit? It's very simple. We're going to take whatever capital is idle and allocate it equally to other 3 systems within the portfolio. If this system's capital was 50k to start with, it only used 30%, as we can see right in the beginning of this chart, meaning that we would have 70%, so 35k left idle, and we take that 35k and increase the other system's position sizing as a result. Once this system starts generating signals again and starts to require capital to do so, we simply allocate its capital back to it and lower the capital allocation of other systems accordingly. Now, this is very easy to do in practice. I personally have Python scripts that take my combined capital's value and then simply multiply it by individual systems' weight in percentage terms to arrive at capital allocated to each system. This technique I'm describing here essentially just makes this calculation more dynamic, depending on how much idle capital is there available to distribute. And here are the results. Annual return up from 48 to 55%, while the drawdown decreased slightly. Now, don't be fooled, this is a notable improvement, and it's because I've not made any changes to individual strategies whatsoever. I haven't added any new rules or indicators. I simply introduced a dynamic capital transfer from one strategy to another within a portfolio. These are the kind of options you get when you trade on a portfolio level. Also, worth noting is that the maximum length of a drawdown went down as well, from around 250 trading days in the original portfolio version with the static capital to around 130 when using this dynamic capital movement technique. And that's it for today. If you trade multiple strategies, give this technique a try. Thanks for watching. See you in the next one.